Thank you for coming back to our Mortgage Investors Network video library. Today we're going to talk about a subject that comes up all the time. Actually, we weren't planning on doing this video yet, but it's coming up so often that we moved it forward to today's video. And that is a question we get asked from our investors. Both myself, loan officers, my partners, everybody gets hit with the same question. And that is, why don't our borrowers go to the bank instead of coming to an independent company like our own? The bottom line to it is, the borrowers still want to borrow money from the bank. But what we have found out through our own experiences, and myself having many years working in a bank, that most banks are no longer interested in small business mortgages. Very often a borrower will go into the bank and they'll find out that the bank is, and their people are somewhat inflexible. They're slow to process a loan. They're slow to close the loan if they're lucky enough to get it in the first place. And many tell us they're even slow to turn the loan down. Very often they walk away from the situation confused and disappointed after bringing reams of paperwork to the bank, only to find out that the bank has denied their loan. And often it's for what seems to be very fickle reasons. There's a mystery there, which we're going to uncover. And we're going to explain why the banks handle these situations like they do. Again, we see through the people that contact us and people we know that borrow money on a business mortgage level, that the banks turn them down every day. And it surprisingly enough, it gets to the point where a lot of these business borrowers, they don't even go to the bank anymore, because they know that even though they have acceptable credit, acceptable income, they have many years in their business, that the bank is just going to very often waste their time. What we found out is there are good, concrete reasons why the banks are no longer as motivated as they once were to do small business mortgages. And we're going to explain why. We're going to pin it down to the most basic three reasons. These are three of the major reasons why banks are no longer interested in doing these small business mortgage loans. The first one is compliance costs. Like any cost, you have to make up for the cost. But in this particular case, banks, especially on an ever-growing basis, have more and more and more compliance costs as they report to more agencies every day, and the information they have to supply and all the requirements that come with new statutes and new regulations and so on and so forth. So one of the first things that happens is more compliance means more staffing, more people to do the compliance, which obviously raises overhead. Having employees is very expensive these days with the benefits and the salaries and being competitive and so on and so forth. So as those head counts go up, the overhead goes up, which forces the banks to raise the minimum mortgage amount. They need the larger mortgage to justify the larger costs. Okay? As that happens, those minimum mortgage amounts, as they climb, that leaves the small business mortgage customer behind. Another important category in this compliance cost discussion we're having is when the cost and compliance go up, the bank tends to streamline their products. In other words, they reduce the number of products they have to offer. Now, that may or may not seem important unless you're a business borrower, because every business is different. And by virtue of that, typically every business request for money is different. The beauty of being able to accommodate a business borrower on a mortgage or anything else is the ability to be flexible, and to accommodate them with deadlines, with amounts, with terms, so on and so forth. When compliance becomes a much bigger issue, it becomes less feasible for a bank to have so many products. So they start to condense their products, which means that now the borrower has to change their request to suit the bank's products, as opposed to what used to be in the past, the bank would accommodate the borrower. That's one of our specialties. Our programs are flexible, and we can accommodate that borrower for all the special needs they have. Where with the banks, they just can't do that. And that is a huge reason for a lot of business borrowers to, at the very minimum, get very frustrated with their bank. As compliance regulations become more cumbersome, the costs go up, the bank is going to ask for more information from the borrowers, which was already pretty intense, but now it's becoming much more cumbersome and expensive for the borrower to go to their accountant and get all the documents they need, or get an appraisal done, get a survey done. In some cases, an environmental study, which they call a phase one. These things are expensive and they take time to create, and there's no guarantee that once you supply this information that the bank is going to do your loan. Anybody can tell you that went for a business mortgage at a bank that they've spent days just gathering information, and the compliance, as it becomes a bigger and bigger factor, is only adding to that. One last point in regards to compliance costs is time. These days, especially here in Florida, a small business mortgage borrower needs answers quickly. Very often they need answers quickly for a variety of reasons. The sooner they can supply funds, the more aggressive they can be in when they put through contracts to buy property, and the chances of them getting the bid are increased by being able to close quickly, because very often they're competing on a purchase situation with cash buyers. So if they're competing with these cash buyers and it takes them 45, 60, even 90 days to get their money from the bank, very often, especially in our atmosphere these days, very often those sellers are going to go to the cash buyer. And this particular borrower is never going to get a chance. That in of itself is a costly proposition for the borrower, because they lose all these opportunities. And this is a fact of life we see every day. The second reason why banks are doing less and less lending to small business mortgage borrowers these days is rates are going down. When rates go down, the margins, or the profit margins specifically, on the loans go down as well. In order to make sufficient funds to pay for the compliance costs, the cost of money, and everything else that goes into it, the loans have to be larger. So again, the minimum loan is rising to the point where it leaves the little guy out, even though his criteria might be very solid and he might be a very good potential borrower. The amount he's asking for does not interest the bank because of all the work that needs to be done. You can't blame a bank for that. They're here to make money. But this is a fact of life. When interest rates go low, a very important factor is funding risk. Funding risk is something that banks deal with and live with every day. And that is the possibility that once they do this loan, in the future, if rates go up, the rate they're going to be receiving on the loan is less than the market rates. As a result of that, because rates are low right now, they make the terms on their loans shorter, or they put special clauses in the loans, which are the ability to call a loan. In other words, at some point in the loan, they can just call and say, we want it paid off. Okay? So those shorter terms make it more costly for the borrower because he's got to renew those more often. And in some cases, the bank is going to ask for semi-annual statements or annual statements or both in order to keep verifying over and over that the borrower still qualifies for the loan once he even has it. So those create paperwork costs that takes time away from the business borrower that has to keep supplying information to the bank. All those things are big factors. Now the third reason is probably the most important reason of all, and that is a law that was put in place in 1933. That was called the Glass-Steagall Act. It was repealed during the Clinton presidency in 1999. Let me explain why this is so important. Back when it was put in place, during the Depression, banks could invest in whatever they wanted. And very often those investments paid a lot more but were risky. And they would put your everyday Joe borrower and a person who kept their savings in the bank in jeopardy. Because if the bank lost money on these risky investments, it could affect the depositors and the borrowers. So this law was put into place. It created a wall between what we call Main Street customers and Wall Street customers. Now you couldn't mingle that money. And that law obviously was in place for 66 years, and it worked well for 66 years. Now in 1999, they repealed it. So how does that affect the small business mortgage borrower? Well, now the bank can take that money that they would normally use to do a business mortgage, and now they can invest that somewhere else. And very often that could come down to a trader and his assistant or assistants. He can make the same amount of money with a staff of 3 that a business mortgage might take a staff of 30 between originating the mortgage, closing the mortgage, servicing the mortgage, and all those compliance reports and everything that they have to produce. So as you can see, the bank is naturally going to go where the profits are. And you can see it now. Banks like JP Morgan, Bank of America, they're trading in silver. They're getting involved in mergers. They're getting involved in all kind of exotic security instruments. And they're making a fortune doing it. So where does that leave the little guy? Again, in some cases, they do mortgages only because they're in our town and they have to keep up an image. So they'll do mortgages when they have to keep up their images. In conclusion, we all know from looking on the news and on the internet and anywhere, you get updated of what's going on in this country. Large corporations get all the press. They get all the headlines. But in actuality, if you dig a little deeper, somewhere between 45% and 50% of our gross national product is small businesses. These are businesses that need to borrow, and they can't necessarily go to the bond market to get the money they need. So those businesses, some call them mom and pop, some are slightly larger than that, they need capital in order to grow and become bigger businesses. Because of the void that these banks have created, a lot of these people find that once the bank turns them down, they have nowhere to go. That's where Mortgage Investors Network comes in. We have found that many of these borrowers are very qualified. They have lots of equity in their property, or they have no mortgage at all. And they have business purposes for borrowing the money. In other words, they're going to take our money and they're going to make more money with it. It's one of the bedrock principles of running a business is conservative use of leverage or other people's money to make your business grow. We feel that these type of borrowers are very important for the local economy. When we do these mortgages, we're not only helping that particular borrower, but that borrower is building his business and it's improving the local economy. And when we sell the mortgage to an investor, that investor is getting a benefit as well. So I think it's safe to say that this is a win-win situation all the way around between all three parties. The mortgages we sell typically have yields, or what it pays you on a monthly or annualized basis, in the 8.5% to 9.4% range. They are conservatively mortgaged or collateralized with property at a maximum of 55% of the value of the property. And they are underwritten or approved by our staff that has well over 30 years worth of experience. Actually, it's much more than that. Those are conservative investments with a good yield. And lastly, one of the most important points is we have already funded these loans. We have already put our money on these loans. We would not have done that unless it was a good risk and we've thoroughly investigated it to the point where we are comfortable with it. So an investor coming along will know that we've already put our money where our mouth is, so to speak. We think that if you do the math, if you see the benefits, if you call us up for any details, you'll see that this is a product worth looking into. What we suggest to most of our investors is take a portion of the money you have to invest and buy one of our mortgages, or two if you like, obviously. You'll find that they are an excellent investment that does not require a lot of work on your part. They're very passive. You can verify all the fundamentals of it, and you're going to get the return you deserve for your hard-earned money. We hope that this goes to explain why a lot of our borrowers and the loans that we currently have on our books are these type of people. They're bankable people, but the banks just would not accommodate them. So we invite you to call. We'll be happy to send you information on our borrowers once you sign a disclosure. And we feel that if you do, you're going to get the return or the yield you deserve. Okay? Thank you for taking the time to listen to me on this very important subject.